The investment outlook is better for stocks now, arguably, than it was in February 2025 because you've got tariff visibility, you have tax and deregulation visibility. The companies survived the fifth major stress test, which I've covered before, which argues multiples should be going up, and the Fed is arguably more dovish next year. Now, President Trump and Fed Chair Powell had a meeting today, but no surprise, it's not as if the central bank has changed their minds, and they're saying that they're going to support maximum employment and stable prices and will make the decisions solely based on objective, non-political analysis. Well, in my opinion, that means that it's going to be easier to make the case for cuts in 2026. Well, that's a dovish Fed next year, which is really, as you think about it, 6 months from now, that should be positive for stocks.
Tom Lee's coming in hot with some serious market energy. Despite a short trading week thanks to Memorial Day, the markets are showing real strength. As of May 29th, the S&P 500 has climbed 1.6%, and the NASDAQ 100 is showing off with a solid 2% gain, not bad for a 4-day week. And get this, pullbacks? Practically non-existent. Dips are shallow, buyers are stepping in quickly, and momentum keeps building. So what's going on? According to Lee, this rally is being fueled by one key factor. Everyone hates it. Yep, this is possibly the most hated stock rally in recent memory. Investors are still skeptical, headlines are still cautious, but the market just keeps grinding higher. It's like the rally no one wanted, but it's here anyway. I think this is the right time to subscribe and drop your spicy takes in the comments. Now let's go back to the interview.
I want to start this video with talking about macro. It's been a short week with Memorial Day, but through May 29th, the S&P 500 is up 1.6%, and the NASDAQ 100 is up 2%. Pullbacks continue to be shallow, and it's our view that they'll remain shallow because this is still the most hated stock rally. Now, what do I mean by the most hated stock rally? Well, I mean, it's been a V-shaped recovery, and investors really have been skeptical during that entire rise. I think it comes down to a sizable perception gap that, in our view, the tariff war and concerns have a bark worse than the bite. Let me explain. For instance, on this week, yesterday on May 28th, the International Trade Court ruled against the Trump tariffs. Now, it didn't remove all of them, but it ruled against them. And on Thursday, May 29th, the D.C. District Court Judge Contreras ruled that tariffs are illegal. So it's two cases ruling against White House tariffs. But on the same day, the Federal Court of Appeals issued an administrative stay, which reinstates the tariffs at least through June 9th. But you can see this is getting quite complicated. And the White House is insisting nothing has changed after the tariff rulings. And in fact, Goldman Sachs highlights that there's many measures the White House can take to implement or re-implement tariffs. But ultimately, the White House is losing leverage, and it's taking us closer to the end game because it's going to be difficult for the White House to re-escalate things when they're losing really court cases. And so I think what we're probably expecting is the White House to look for an off-ramp. Now, this is not a surprise because tariff threats have led to concessions, just like the DOGE cuts, even though they're less than expected, have led to concessions. And even this budget and reconciliation bill, they don't have the cuts people are expecting in spending, but they have concessions. Now, hedge funds have increased their short interest recently, and that's contrary to what you expect, because when the market's rallying, you think hedge funds should be covering their shorts, but that's not the case. How short interest is increasing for the average stock. And there's still $7 trillion of cash on the sidelines. But maybe most importantly, and I've said this before, the investment outlook is better for stocks now, arguably, than it was in February 2025, because you've got tariff visibility, you have tax and deregulation visibility. The companies survived the fifth major stress test, which I've covered before, which argues multiples should be going up, and the Fed is arguably more dovish next year. Now, President Trump and Fed Chair Powell had a meeting today, but no surprise, it's not as if the central bank has changed their minds, and they're saying that they're going to support maximum employment and stable prices and will make the decisions solely based on objective, non-political analysis. Well, in my opinion, that means that it's going to be easier to make the case for cuts in 2026. Well, that's a dovish Fed next year, which is really, as you think about it, 6 months from now, that should be positive for stocks. Now, turning back to Granny, ticker GRNY, this is the return of the 40 constituents. And as you can see here, Granny slightly underperformed the S&P Total Return Index. The top 5 contributors to positive performance are listed here: GE Vernova, CrowdStrike, Robinhood, Google, and Monster Beverage. And the bottom 5 performers are here. But of these 5 bottom performers, the one that was the biggest drag was FICO, which fell 23% for the week. Now, FICO is a recent add to the Granny Shots, and FICO is the company that gives you a credit score. Well, sometimes Washington picks winners and losers, and we can't help but really be subject to how that buffets stocks. For instance, one of the White House cabinet members talked about how they're disappointed about the cost increases by FICO, and that some credit reports have become more expensive under Biden's term than they were under Trump. And in fact, Bill Pulte from the FHFA is even proposing some changes that will negatively affect FICO. Now, I don't know if he has a personal issue with FICO or just has personal issue with rating agencies or with costs, but these are going to be buffeting FICO. And even though FICO has argued that these might have de minimis effects, the fact of the matter is, as Tom Block, who is the policy strategist for Fundstrat, likes to say, when you are explaining, you are losing. So it's really an uphill battle for FICO at the moment. And we can see it in the stock price. This is the 6-month price chart for FICO, and we're using some DeMark indicators here. Now, do you notice these 13s here? These are for 2 different counts of DeMark, but a 13 is called a sell setup. And after that sell setup was established, you can see FICO fell 33%, had basically a waterfall decline. Now, after falling 33%, you can see a series of green numbers here, which is currently at 7. That's because it has consecutive closes that are lower than it was 4 days ago. Now, this may get to 8 Friday, and it might get to 9 next week. And when it does, it creates what's known as a possible buy setup on DeMark. But there's no guarantees that's going to happen. And it's coming at a time when FICO is oversold. So it could be something that could lead to a stabilization of the stock price. I'm not sure at the moment. But at the moment, we'd say the best takeaway we have is just give it a week or 2.
Markets are back at all-time highs, and Tom Lee says this is just the beginning. He believes the market is actually in better shape now, thanks to stronger fundamentals and fewer macro risks. Lee's sticking to his bold S&P 500 year-end target of 6,600, confident that the bull run still has room to go.
As you know, the S&P went into a tailspin on fears of Tariff Liberation Day. It was a waterfall decline. There have been 18 such waterfall declines that our team identified since 1900. And for those who have been following us know that we have been calling for that waterfall decline to lead to a V-shaped recovery. Not a square root, not the markets would be flat the rest of the year, but that we would rebound sharply and recover the old highs. That happens 17 of 18 times whenever you have a waterfall decline. In fact, that's what's happened. We're back to the all-time highs now. And you may be wondering, does that mean stocks are just going to go up to the old highs and that's it? That's not our view. Our view is that the market is in a better place now than it was in February when we made our old highs, because there's deregulation ahead. There's tax cuts ahead. We have a lot more understanding of tariffs, which seem to have more bark than bite. And companies survived a stress test, which, as you know, when you survive a stress test and you don't fail, that means you're going to get a multiple expansion. So I think S&P can still reach 6,600 by year end. And that would be consistent with basically a bull market starting on April 7th. I think that this is just investors trying to understand where Apple fits in the new tariff world, right? In a world where there's pressure to bring manufacturing back. And I think that's all going to be ultimately noise, because where Apple makes its product, it might be politically unpopular, whether they keep it in China or move it to India or attempt to build it in the US. But what has not changed is Apple is one of the most central products in everyone's lives. And they've done a good job of creating an ecosystem that works really well, and they've protected your privacy, and they've done it in a way that actually is at a reasonable cost. So I don't think Apple's competitive advantages are changing. I don't think in a new tariff world, suddenly we're all going to be buying some startup American product. And even within the world of AI, Apple has never been bleeding edge. So I don't think you should be too concerned that Apple is actually late on AI. So for all those reasons, it's, to us, it's still a bedrock granny shots idea. But I think from a timing perspective, that's something better to ask Mark about. That's kind of losing sight of the bigger fractal. NVIDIA is a central player. I mean, the central player in AI. There is no competition. And I think if the stock does pull back, it's not any indication to us that there is any change to our thesis. So, I'm not really too concerned what happens tonight after the report. If it's up or down, to us, it's still really a central player.
Lee also weighs in on Apple and the global manufacturing shakeup. Yes, there's pressure to bring supply chains back to the US, but Lee says Apple's core strength sits ecosystem, customer trust, and product quality are still rock solid. Worried Apple's behind in AI? Lee reminds us, Apple's never chased hype. It doesn't rush, it refines. That's their edge. In his view, Apple is still a must-have for any long-term portfolio. Or just here for the AI appliances, we want to hear it. See you in the next one.